I think let's have, without further ado. So we're delighted with the way this conference is going. We're very delighted people chose to participate at your level, junior, senior, all over the place, from the other side of the world. And we're particularly happy to have Francesco coming to give us his sort of leading light on acquiring influence in this. When you study institutions, it's very complex because everything depends on everything, in a sense. Everything is endogenous in some sense. And there is all discussion on the political economy of finance, where politics affect finance. And it's also interesting to ask the question of finance affect politics. So the topic sounds fantastic. Francesco is known to all of us. I was told that I don't need to introduce him very much. He graduated Harvard, went to UBC. He came to Frankfurt to talk at a very popular presentation about something that was important for the ECB to put forward at the time of the formation SSM. It took away regulatory authority from national authority and gave it to sort of more federal entity. Remember that with great pleasure. It's here in Berkeley now. Francesco, I've spoken enough. Thanks for coming and delivering us to this general keynote.
Well, thanks, Enrico. Thanks, Thomas and Magdalena, and everyone here for listening. It's really a pleasure to be here with you. Sorry if I couldn't be here sooner. I will need to be able to share my screen. I don't know if you guys can allow me.
Now you should be able to, yes.
Thank you very much. Sorry about this little intermission. It's one of the. You should be able to see my slides now. All right. So I was asked to give a little bit of an overview of a very active area in political economy, which is my field and the field of many in this virtual room. So I titled the talk "Investing in Influence." I would like to start with the question that I think everyone here is thinking about, and it is why studying political and regulatory influence so important. Okay, now we need to be a little bit humble here and recognize that there are many ways of answering this question, and some of them come from other disciplines, including political science, political sociology. But today, obviously, I'm going to take more of an economic perspective because it's the one where I can have I can speak with a modicum of competence, and but I want to frame it using Philippe Aghion, what I call the Aghion's conjecture. So Philippe Aghion is this prominent scholar in the study of economic growth and innovation, and it strikes me as a very important starting point for motivating why we want to study this. In the slide here, you have pictures of two gentlemen that you know probably. You recognize on the right side Steve Jobs, an innovator and entrepreneur who became one of the wealthiest men in the world through essentially products like the iPhone. And on the left side, Philippe Aghion always places this kind of counterpart, Carlos Slim, one of the richest men in the world, and someone, however, that became influential and rich mostly through leaning heavily on governments, particularly his initial fortune developed around the telecom privatization in Mexico. And what the Aghion conjecture kind of posits is, particularly with respect to the analysis of top income inequality and recent trends in our economies in the last 20 years, is that this Carlos Slim kind of example is really emblematic of a potentially malicious cycle that is happening in our societies today. And this cycle is really the motivation of why we want to study this. So here it goes, what I think I wouldn't be mischaracterizing as the Carlos Slim cycle. You start with a financial economic cloud that translates in political power, special interest influence, and political cloud that affects government policies, tilts the rules of the game, that kind of reinforces ring fencing of rents, and further amplifies financial economic power in an increasing cycle that, as a byproduct, has not just top income inequality of the Carlos Slim cycle, not of the Steve Jobs type, stifling of innovation and entry because of barriers that are set through the rules, sluggish productivity growth, which is typical of our economies, unfortunately, of late, and unpopular policies and massive political pushback, which I think it's at the root cause of populism today. So this kind of cycle, I think, is extremely important because it kind of finally clarifies very explicitly why issues of redistributions are not are matters of efficiency really in our economy, and we should be extremely worried about this type of amplification mechanisms that go often underappreciated within the economics profession overall, but us as political economy and financial political economists, we really do care a lot about. Now, without trying to be grandiose, I've worked a little bit on some of these mechanisms, okay? The transformation of political power into policy and the distortion of policy is part of my, it's covering part of my work on special interest politics. But today I'm gonna mostly focus on the other element of this chain, the linkage between financial and economic power and political power. So how this amplification mechanism happens in our economies and in our financial systems. And I have here listed the 3 papers that I would like to talk about today, because they, in a sense, not only speak of this linkage, but also show you how complicated it can be to really trace out in the data this kind of mechanism. And I think the natural opacity of this mechanisms is one of the reasons why they're also vastly understudied, in my opinion, relative to the potentially tremendous welfare consequences that they have in our economies today. So there is a complication in studying this cycle, and the complication is just all the elements in the cycle are empirically hard to identify, and therefore it's hard to say something that is systematic. Now, much of the interest in this literature is about campaign contributions and lobbying, but that's just because they are the visible and disclosed form of influence. Okay, so we are really a little bit distorted by the fact that we're looking for the keys under the lamppost, in a sense. Okay, and what is the realization that at least personally I had over the last 10 years is that there are plenty of undisclosed and hard to trace mechanisms that are going on. And for today, the application is going to be mostly the United States, where I have the data, where we have the data. But it would be fantastic also to study this with respect to Brussels and the EU. So some of these hard to trace mechanisms are dark money, you know, just the name itself. These are 501c4 organizations that are completely obscure with respect to the people that put the money in these entities, and then therefore these entities become this kind of absolutely amorphous objects that populate progressively the political economic landscape in the United States. But there are other channels that are seemingly innocuous. We find evidence of politically driven charitable giving, so philanthropic activities by large corporations that are politically directed. We find forms of tax-exempt indirect regulatory advocacy through philanthropy, through third-party grantees that essentially lobby on behalf of a large corporation to regulators. We find amplification of political donations through common ownership linkages. So I'm going to show you today an example of this by looking at the relationship between political giving of large investors and the firms that they acquire. And the list is growing. And these are basically all mechanisms of amplification of financial clout in terms of political voice. And basically, that's going to be kind of the core set of issues I would like to talk about today. Now, in case you're wondering whether these particular channels are an abstraction of my mind or not, here I put a document that was obtained from the judicial litigation on the tobacco companies in the 1990s. So this is from a Philip Morris documents in 1992 that shows what they call there the influence wheel that they were using, like literally using within Philip Morris to define how to affect legislators. And some of the things that you see listed here in terms of the chains of influence include, for instance, charitable giving to the legislator or to the congressional district of that legislator, and not just direct contact and lobbying or the use of special constituents in the jurisdiction of that politician. So, or the media, which are more standard ways of thinking about influence. So you're seeing these are not things that come out of a fantasy land, but they are really documented even in these disclosed documents that were released. These were confidential records that were released only because a judge made them available to the public. And in my research, I have plenty of documents like this that show the inner workings within these large corporations. And some of these activities, let's just be immediately upfront about this, are perfectly legal. But they are so opaque and obscure and hard to trace that voters essentially have no recourse. It is virtually impossible for a regular individual to go and check 990 tax forms of non-profit organizations in order to see whether the stance of a non-profit organization is affected by a large grant received by an S&P 500 corporation. I mean, let's be honest about it. But not only the average Joe cannot tell whether the voice of, I don't know, Save the Children or the American Pediatric Dentistry Association is influenced by a gift from Coca-Cola, but also regulators at the FDA or the FCC have no idea that this is going on in the back, and this is only available to us through painstaking data work that basically merges tax forms to disclosure, other disclosed data, and balance sheet information of these corporations on top of regulatory document. So this is something that basically traces a little bit the theme for today. So I'm going to start from 3 examples of this, okay? These are based on my research with my wonderful colleagues, so Matilde Bombardini, Marianne Bertrand, Ray Fisman. And the first paper that I'm going to talk about that kind of focuses on charitable giving of S&P 500 and Forbes large corporations. I mean, these corporations are so big that typically have associated to them a 501c3 entity, a large nonprofit that acts as essentially as the channel through which charitable giving is given out by these corporations. And the things that we discovered in this research is that the charitable giving of these large corporations follows a pattern that is virtually identical to political campaign contributions by those corporations. What we show specifically in the paper is that when politicians move in and out of congressional committees that are relevant to firms in that particular point in time, think about looking at what firms are lobbying on in that particular time period based on the lobbying forms that the firms have filed and match them to the congressional committee oversight issues and then looking at what happens in each congressional district over time, we find that charitable grants from this large corporation to the congressional districts of those politicians increase when these politicians start working on issues relevant for the firm and drop when they get out. So think about it this way. You have essentially that Bank of America Foundation starts dishing out grants to congressional districts where politicians start sitting on the banking committee and immediately stops giving out these charitable contributions the moment they step away. The thing that is important about this is not just that these donations are happening, but their sheer magnitude. Because philanthropic activities in the United States are enormous in terms of total magnitude. We are talking about a channel of political influence that is way larger than official campaign donations by corporations. Okay, we are in excess of $1 billion per year as of now, based on our calculations. Now, I would like to make clear in this slide that we're not Taliban, in the sense that we're not seeing all corporate social responsibility activities by these corporations as being politically driven. According to our estimates, which are based on a model in the paper, 7 to 8% of all charitable giving is political, so not by far, not all of it. But again, because we are talking to relative to a much large base, this is you know, billions of dollars that go into political influence that before this paper, I think, were mostly undetected, or at least weren't systematically traceable. Now, just to show you the type of empirical analysis that we could do in this paper, I'm going to start by looking at the campaign contributions accruing from firm F to a congressional district D in a certain electoral cycle. And I'm going to regress that on essentially a measure of the issues of interest for the firm F related to the issues that are covered by the politician in D. So that's our independent variable is essentially the degree of importance of that particular politician to the firm. And as you can see, as the importance of a politician to the firm changes over time, campaign donations increase. This is within foundation firm congressional district pairs. So this means that everything that is related to the firm interest in that congressional district is taken care of, and these are just variation over time. I see there is a question in the chat. I won't be able to man the chat, Thomas and Enrico. So if you find questions in the chat, feel free to interrupt me, and I'm very happy to answer questions on the fly. I will hate to hear myself talking for an hour straight. It's really, I'm a dreadful speaker, so please forgive me. So the analogy here is the following. If you do exactly the same thing for charitable giving, you find exactly the same pattern. Exactly the same pattern on a qualitative scale. This is precisely the same sort of variation. Just to convince you that even graphically that this is going on, let me show you two pictures. So on the left side here, you have political action committee giving. So this is official political donations on the left, charitable giving on the right. And this is basically the progression over time. Think of some sort of event study that traces the amount of money that accrues to a specific congressional district around the retirement of a politician. Now, as you probably know, and you're familiar with this, much of the power in Congress is driven by seniority. So over time, you obviously have an increase in the amount of money that accrues to a congressional district just because the politician in that district is increasing in its his or her importance in committees and Congress overall, because so much is tenure-based. The moment of the retirement, the money goes down and then starts accruing again when the rookie that was just elected acquires a little bit of clout due to tenure. So this is kind of a relationship that it was new, but kind of obvious. The interesting thing is that on the graph on the right, you have exactly the same type of dynamics. As if Bank of America would start giving to the local hospital or a food shelter more and more over time. And then when the politician retires, that stops. And you may wonder why politicians would care about charitable giving in their districts. And the answer is what political scientists would clearly emphasize here, which is credit claiming. These are the guys that like to go and cut ribbons when new projects are instated, when they can basically put their face next to projects that are valuable to their constituents. So this is a channel that was totally unexplored and is part of this Carlos Slim mechanism because of the amplification of the political clout of these corporations through this. The second example that I would like to talk about comes from regulation, which is a topic of the conference, and to a certain extent is related also to the discussion on complexity that we just had before. So one of the areas where I dedicated a lot of my research without much without much success, I have to say, is the Dodd-Frank Act of 2010. The Dodd-Frank Act of 2010 was a massive financial regulatory reform bill. Okay, President Obama, who signed the bill, claimed that it was one of the most lobbied bills that he had to sign into Congress, maybe only at the same level of the Affordable Care Act. And this is not surprising because it was, even the statute itself, like the law itself, was 848 pages. It included 398 rulemaking requirements, and he ended up filling tens of thousands of pages in the Federal Register. He covered everything from securitization reform in Title III, limits to proprietary trading, the so-called Volcker Rule in Title VII, capital requirements for large systemic entities of above $50 billion in total assets. So it's obvious that it was going to get lobbied heavily. But the thing is, we really don't know what happened in this, even in this specific case. Obviously, if you ask regulators, if you ask people at the Fed, what they're going to tell you is that this regulatory reform was extremely successful. And how do they back that statement up without much evidence? They're going to show you something like this. They're going to show you like tier 1 capital ratios for banks that were large and systemic before the crisis, and then the sudden increase in essentially the safety and soundness of those banks by increasing their core capital levels immediately after the crisis. So if you ask people at the Fed, they're going to claim success just based on time series evidence of this type. But really, we don't know. Really, we don't know. Why? Because that particular piece of legislation went through 398 regulatory rulemaking elements in which the influence of special interest is completely untraceable. For those of you who are not familiar with the process of rulemaking within the United States system, as it is dictated by the Administrative Procedure Act of 1946, it works like something like this. Once a law is passed, then the law mandates to regulatory agency to start from a proposed rule, okay? This proposed rule is published, and then meetings and comments happen with industry participants and the public in general. This is the so-called notice and comment phase of the regulatory rulemaking, and then a finalized rule happens. As you can see from this slide, even just on the Volcker Rule alone, which is 10 pages of the Dodd-Frank Act, you had 17,000 comments and more than 250 comments from banks alone. And these 250 comments from banks alone weren't like one-page comments, okay? They were sending books. Like Bank of America comments on the Dodd-Frank Act were ranging in the 200 pages of material. In terms of just sheer numbers, as I mentioned before, the Volcker Rule is a nice example. There was active discussion there about proprietary trading on the part of depository institutions. So the question was, are banks allowed to use their deposits to make private investments and cash in on their returns, but expose their depositors to risk? So the original Volcker rule was 11 pages. The proposal in this rulemaking initial element was 300 pages. Okay, so now here's the discussion of complexity. The final rule was 1,077 pages. Now, we can discuss all you want about the complexity of modern financial systems, but one thing should be pretty clear. A rule that is 1,000 pages is virtually unenforceable because there are so many conditions and loopholes that make it so essentially unenforceable. Now, in my little taxonomy of things that can happen to regulation, this is what I would call the death by 1,000 cuts, where in this phase of proposal of comments, which I left blank in the 17,000 comments, there were so many different instances that were modified, amplified, or diffused that produced this kind of bloated type of document. Okay, so hopefully this ties to the previous discussion. And what can we say about such a complex environment? Okay. So I don't have much to report in the way of a clear understanding of the notice and comment environment. However, we have worked extensively with Marianne, Mathilde, Ray, and also Brad Akinen, who's in the audience and is really an expert in this area. We have worked on essentially the notice and comment regulation environment. And we started to show systematic patterns in this environment. So in this paper, which is titled Hall of Mirrors, Corporate Philanthropy and Strategic Advocacy, we start some of the groundwork to understand what's happening in this phase, okay? Now this work is again focused on channels of influence that are not obvious. We show that charitable giving suddenly surges, so charitable giving by large corporations suddenly surges the year just before a regulatory rule of interest to the firm comes up. And this charitable giving goes to grantees, okay, that do not disclose to regulators these donations, submit comments to regulators on the same rules that the firms are interested in, and these comments are abnormally more similar in a statistical sense based on measures that are obtained through natural language processing techniques which we have developed with Brad, to the firm submitted ones. In addition, this technique seems to be working because comments that are submitted by these non-profits make a firm position more salient to regulators. We find that in terms of similarity of the discussion of the comments of the firms to the final rules discussion by the regulators, there is a substantial increase in that similarity, meaning the regulator is responding to issues raised by the firm more when this happens. Now, again, you may wonder whether stuff that is so convoluted really is systematic. I won't give you the tables in the paper here, but I want to tell you about some examples, okay? And they're not all from finance, although I have a bunch from finance as well in the paper. Okay, so let's go through this very first quote here. So this quote comes from leaked documents describing Monsanto funding to nonprofits that would advocate government agencies against the banning of its pesticide, the Roundup pesticide. Okay, so here's what it's in the document. It says that the key will be keeping Monsanto in the background relative to essentially the statement by these grantees, so that as not to harm the credibility of the information. So there seems to be this triangulation that is happening where essentially firms prompt nonprofits to lobby on their behalf to regulators with the intention of essentially producing signals that are perceived as relatively more arm's length relative to the one that the firm itself would send. And because the regulator cannot trace this funding in an easy way, that typically this works. Another example below. Save the Children, a group that promoted soda taxes and sugar taxes, suddenly dropped this effort in 2010 after receiving more than $5 million donation from the Coca-Cola company and Pepsi Cola in 2009, so immediately before that. So this kind of examples are yeah, obviously very salient, but there is really a ton of them, from tobacco to agribusiness to even financial regulation. An example from Dodd-Frank, the Green Lining Institute, which is essentially a nonprofit focused on essentially minorities and access to housing, lobbied the OCC immediately after receiving a $150,000 donation from Bank of America, essentially advocating the same position of Bank of America in credit risk retention rules, which are Title III of Dodd-Frank, essentially claiming that those restrictions that would impose originators of mortgages a certain share of those mortgages to be kept on their balance sheet just to make sure that they would do the due diligence on those mortgage origination was essentially reducing access to housing in the United States and would increase the cost of borrowing for minority households. So these things are very commonplace. We show in the paper using the entire universe of notice and comment regulations that this happens systematically. I don't know if there are questions at this point, or but I can move on my third example if there are none.
I have a question actually regarding the external validity of these findings. Do you feel this
external to the US?
Yes. So is it specific to the US, or how would you view it as externally valid to other countries?
You can bet that this is happening in Brussels right now. I would bet money on that. It just I don't have the data to back that up, but this seems to be widespread enough and has been going on for a long time as well.
Well, let me cite a short episode that happened in the Netherlands. The parliament adopted legislation that was relevant for banks, particularly on the issue of securitization, which turned out to be kind of copy-pasted from a lobby group. Create quite a shake. I mean, it was literally, they didn't even, you didn't even need the kind of more sophisticated reading interpretation of that you're doing on language. It actually was quite a shock, and it went public, and here he had some effect. He undermined the bankers' position when they tried to lobby against the leverage ratio, which is a national, to some extent, a national add-on component.
Can I ask a question? It's Paul Tucker.
Yeah, absolutely.
I completely agree with you that lobbying of this kind can drive a particular policy or rule to complexity that undermines it. But how do you distinguish that from a policy, a legal rule that just can't be implemented? And the reason I ask is, you gave the example of the Volcker rule, which I completely agree with you. It was unworkable. A week after President Obama had announced, with Paul Volcker and Tim Geithner, the Volcker rule, I was asked by the British Parliament whether we, the Bank of England, thought the Volcker rule was a good idea and whether we should do it in the UK. And the answer I gave, which is on the record somewhere, I can't remember my exact words, but was, it is a good idea in principle and it will prove impossible to implement. For me, the question of something like the Volcker rule is not how it gets undermined by millions of comments, but it's why a government doesn't reasonably quickly realize that they have got an unimplementable policy and change course. And I think the question for research is how can we tell the difference between unimplementable policies that get thousands of comments and implementable policies that get undermined by thousands of comments? I've merely asserted that it was unimplementable, but I'm prepared to defend that. But let's take it as a given that it was that there are sometimes unimplementable policies. How would one distinguish between the two phenomena?
Yes. No, these are interesting points overall. I mean, I don't want to make too much of the Volcker rule. It was just an example, but in the taxonomy of things that happen on Dodd-Frank, that was emblematic because of its essentially for the particulars of that example. There are other examples. For instance, the credit risk retention rule was killed in a completely different way. They created a loophole for qualified mortgages that initially would consider excluded from this risk retention any mortgage with a 20% down payment. And then they modified that instance, okay, making the exclusion based on some sort of internal projections on the risk assessed of each individual household. That essentially, that particular definition of qualified mortgage exempt from this risk retention ended up excluding from the oversight of the rule 98% of mortgages originated in the United States, basically meaning the rule was killed in a completely different way. The loophole, this exclusion became essentially the norm. So let's now make the Volcker rule essentially the typical modal representation of this, although I understand that was a complicated problem. Many different things happen here, and what I'm trying to emphasize is that essentially this works through also, but not exclusively, an amplification mechanism that goes through channels that are very, very hard to trace, but they seem to have effects on these rules ultimately. And but thanks again for pointing these things out. Now, this process of amplification takes, as I said before, many forms. Here's another form, and this is my third example for the complications that are around estimating structural parameters of this Carlos Slim cycle. Okay, this third paper, Investing in Influence, that's kind of the title of my presentation and of this paper, Investors, Portfolio Firms, and Political Giving. It's a much newer paper, so I'll spend a little bit more time just because it's newer results. Okay, we move away from regulation, we move away from charitable giving, and we're looking at the political spending patterns of investor firms. So we think about 13F filing investors, so large $100 million plus assets under management investors, and the political spending of the firms that they acquire. Okay, so what we are seeing in this, if I can give you the punchline of the paper, is that essentially post-acquisition, firms that are acquired start giving a lot more like the investor that acquired them. Okay, now these are not full acquisition. We look at block acquisitions of about something larger than 1%, but they're substantial block acquisitions. And what this ends up doing is amplifying the investor's political footprint, because essentially now you have the firm essentially adding to your donations their own. Now, I don't know how many here have a very fine knowledge of campaign finance rules in the US. This may not be externally valid to a certain extent, but we tend to believe that there should be limits to campaign finance on the part of private entities to limit corruption or the appearance of corruption. At least that's kind of the legal standing in the Supreme Court in the United States, okay? Because of this quid pro quo nature, right? You literally have political action committees for these corporations giving money to politicians, and this money is disclosed. Okay. However, in recent times, and despite limits placed on donations by individual citizens, the Supreme Court, particularly in Citizens United, but also in other subsequent ruling, has upheld the right of individuals to give through associations, including corporate PACs. So not only you as a wealthy individual can give money to politicians, but you can do it through your companies. and that's totally legal, but that produces a massive amplification of your, if you think of money as free speech, that's a lot of speech that you can give, as opposed to, you know, you and me, or actually not, I'm not a US citizen, so I cannot give money, but take your closest American friend, that the money that they can give to politicians, assuming that they're not, you know, wealthy investors. So this kind of amplification is something that, again, is totally undisclosed and unknown. Now, I just want to make sure that when we are talking about amplification through donations, we are clear that there are many other ways in which this happens, and investor activities are just one of the main elements. Bundling of campaign contributions is something that is happening, and for instance, lobbyists in the United States need to disclose their bundling activities. Super PACs also operate essentially as massive amplification mechanisms. And also 501c4 organizations, essentially dark money organizations, do actually operate in the same amplifying way, with the exception that these 501c4 organizations do not have disclosure requirements to the general public, although they need to disclose to the IRS and the Treasury. Unfortunately, that hasn't changed even under President Trump, even if there was a discussion of whether at least that data had to be deleted or not. Okay, so the distinct channel that we work on in this paper, and again, this goes to this massive reinforcement of the transmission of economic power into political power, is by exploiting ownership to influence the political giving of portfolio firms. And this is also an issue that is in the political economy side of the discussion that you have now in IO on common ownership. And therefore, I think it's kind of a little bit broader than just a mere political economy environment. So what do we find in this paper? The political giving of investors and portfolio firms are much more correlated after a block purchase. This relationship is causal, and we can claim that because we can look at exogenously generated acquisitions due to index inclusion. So acquisitions that happen because the investor has to mirror the S&P 500 or the Russell 2000 index by mandate or as a strategy, and that basically produces an acquisition. And this acquisition, as a byproduct, induces this sharper realignment of political giving. Okay. Now, you may wonder whether it's plausible that it's the firm's donation adjusting to investor preferences rather than vice versa. And the answer is that that's the case, because we find that the giving of investors is stable between pre and post acquisition, and it's the firm donation vector, is the process of donation of the firm that really changes around this event. Okay. In addition, we do the due diligence of looking at the margins of heterogeneity, where we would need to see some more activity in the data, because we think there is more scope for interesting variation there. And we find that our effects are stronger for political and partisan investors. So investors that give a money that is very much skewed politically, or they have more leeway because they are private investors. Think of Citadel. Also, we find that when the investor acquires a board member after the acquisition, this produces an even larger convergence in political giving between the investor and the firm, just like as you would expect if really was the investor having a say on the firm's political activities. Now, in case you're wondering about data, I've talked extensively about data and Forms 990 so far, but let me bore you for a little bit more. Now, obviously, in terms of dynamics over time, you need to look at the type of investors available. These are the large 13F filing investors. They disclose quarterly their holdings, and we got those from Thomson Reuters. The firms that we consider in our analysis are the firms in the portfolio of acquired investors. So this is a selected subsample of the total population of firms that we could think of. And the time dimension is the electoral cycle, because that's the dimension of the political giving. Okay. Much of the analysis is going to be at the investor firm pair, interacted by congressional district and electoral cycle. So literally think about the most fine-grained type of representation of the political choice set that these entities may have. In our data, we have about 90,000 investor firm pairs. Obviously, we are focusing on the margin that has more variation. So the House of Representatives, those are 435 seats, and then 19 electoral cycle, okay? As I said before, we have investors data from Thomson Reuters, and we distinguish between two types of acquisitions, index-based, and those are essentially exogenous acquisition from the perspective of the investor they have to acquire, and non-index purchases. We have politically active investors versus inactive based on the total campaign donations overall being above or below median. Partisan versus balanced investors based on the political skewness of their giving, fully Republican investors versus fully Democratic investors. Private funds versus public funds, and we operate on those margins for the heterogeneity. Like a typical regression model for this is something extremely simple, looks at the donations by firm F in cycle T to politician C, so to the congressional district C, as basically function of the same thing, but for the investor, pre and post acquisition. So this is the pre and this is the post acquisition degree of conditional correlation between these patterns of giving. So this is very much disaggregated on the vectors of giving, that is the decision of each firm to give to a specific politician in a specific time. We look at each element connections to between the firm and the investor. And this F here represents a fully saturated set of fixed effects that not just include investor firm, congressional district, fixed effects, but also their interaction over time. So a typical regression in our work here looks something like this. As you can see here, this is kind of a fairly saturated specification with this firm and congressional district and congressional cycle and investor and congressional district fixed effects. That there is a strong increase in the conditional correlation between investor giving and firm giving post-acquisition. As I said before, this is literally looking at the most saturated specifications that you can think of in this multi-way panel model. So we're pretty sure that this kind of patterns hold systematically in the data. In terms of magnitude, in terms of magnitude, you have a 25 to 50% increase in political giving alignment post-investment relative to baseline based on the estimates of these conditional correlations. So these are sizable convergences in the patterns of giving. As I said before, you may wonder whether this is simply the result of time varying and observed changes in firm and investor preferences that induce both the acquisition and the patterns of giving. And I'm going to show you the index level acquisitions that are essentially controlling for this, because those are completely exogenous. And the fact that investors influence firms follows from an analysis of the patterns of serial correlation of the donations over time for the two different sets of organizations. Now, this is the index-based acquisitions. As you can see from the analysis, the story is exactly identical, if not qualitatively stronger, quantitatively stronger. And so that kind of is very reassuring to us in the sense that we have been able to pick up something that is causal. If you want to see this event studies graphically, so here you have essentially the degree of correlation before the acquisition, and then you start to see after the acquisition happens that there is this increasing convergence. So the red line here is the index-based acquisition, the blue line is all acquisitions. But you see that essentially the political giving of firms and investors starts to look a lot more like the same thing after the investor acquires this large block. You can look at this in terms of cosine similarity of the vectors of giving or the coefficients in the regression that we have. And so we have basically the same patterns in the data. Now, in terms of heterogeneity by investor type, we find that private investors, which have a lot more leeway relative to publicly controlled investors, do more of this political amplification. Think of Citadel and Paloma. Citadel is heavily Republican in its giving. Paloma is heavily Democratic as well. Above median PAC giving investor during the sample period produces more amplification. And partisan investors as well do actually employ this much more heavily. So just let me show you the empirical analysis of this. Again, we are focusing on the increase in conditional correlation post-acquisition. You see that private funds are stronger in terms of this increase in covariance than public funds. Same for politically intense funds versus not. And then more partisan funds as well relative to funds that are more balanced. So these are kind of margins that make sense if you want to use your donations politically. These are the funds that should respond more clearly. And again, we have the fully saturated set of fixed effects in all this analysis. So we know in a sense that these are kind of fairly robust to the best of our abilities, conditional correlations. With respect to board membership, this is another feature of our data. We marriage it to board X. Okay, so as you can see, this requires a little bit of additional data. About 5% of all purchases in our sample, so this is a selected subsample, okay, are associated with a post-acquisition board seat. Okay, and this acquisition board seat pushes even stronger, even higher the conditional covariance relative to the baseline effect that we already documented. So in a sense, this is another sanity check for our analysis that show that this pressure is probably originating from the investor. Now, I mentioned this already. How do you show that it's coming from the investor? Let me show it to you in terms of think of the similarity between the giving of the firm at different points in time. So think of this as the vector autoregressive, essentially structure of persistence. The persistence for the firm is much lower than the persistence for the investor around the acquisition. And we show that in many different ways, but essentially think about it this way. It's the firm that is changing their donations as opposed to the investor. Again, this means that the investor is transforming his economic power into political, in a larger political footprint, because he's using this kind of firms to do their bidding. And we can show this using different measures of the angular similarity of the vectors of giving of firms and investors before and after acquisition. Okay, so that's, again, this is a very robust pattern that we see in the data. So these acquisitions seem to be related to this amplification. Now, you may say, is this good or bad? Well, this is the essence of estimating the full cycle together, right? This is just one element of that chain, but if you're thinking about the Aguillon's conjecture seriously, then you start being worried about this kind of phenomena. So I think I'm almost out of time. I would like to state my conclusions now, okay? So we posited this simple way of thinking about the problem of amplification of political influence of these economic actors. I only focused on one element, okay? We haven't focused on political distortions that come from this, other than in considering in case 2, the effects of comments by firms on the rules. But I think that's a very important dimension of the political economy problem. Investing in influence is a key element of the cycle, however, and so it was important for me to clarify that. These are not channels that you will easily find in the data unless you start doing the due diligence of linking tax forms of nonprofits or 13F filings to political donations. So it requires a little bit of painful data work, but it can be done. And so these three examples today wanted to show you how this can be done, and it's possible, and you can basically present some solid empirical evidence that hopefully with the help of many in the audience will help us clarify exactly what are the consequences of the cycle for our economies overall. I would like to thank everyone for listening, and I'm happy to take a couple of questions if there are now.